All right, so we are going to be talking about chapters 13 and chapter 14. So we have 4 questions here in this review. Let's start off with question number 1. Ortiz Corporation issued 2,000 shares of common stock. We need to prepare the journal entries for the issuance of stock under the following assumptions. So we have 3 different scenarios here. The first one, the stock had a par value of $5 per share and was issued for a total of $52,000. Second part, the stock had no par or stated value and was issued for a total of $52,000. Or the stock had a par value of $5 per share and was issued for land worth $52,000. So we need to prepare these journal entries for each of these scenarios. So the first one, Ortiz Corporation issued 2,000 shares of common stock. Stock had a par value of $5 per share and was issued for a total of $52,000. So we are issuing stock. When we're issuing stock, we are selling it to our shareholders. Right? So us as the company, we are getting cash. So our cash is going to be increasing, so we need to make sure that we debit cash. Why are we getting this cash? Because we're issuing common stock. And so since we're issuing common stock, we are going to credit our common stock account. And then we're going to have this third account. We're also going to end up crediting paid-in capital in excess of par. So now that we have all the accounts for our journal entry, let's figure out the numbers. So cash. How much do we need to debit cash for? Well, this is how much money we are getting in this transaction. So we issued these 2,000 shares of stock for $52,000. So we are getting $52,000 in cash. Now, for common stock is going to take a little bit of a calculation. So we're going to take the number of shares that we are issuing and multiply it by our par value. So we're issuing 2,000 shares. Our par value is $5 per share. So if we multiply those two together, we end up with 10,000. So the amount that we need to credit common stock for is that 10,000. Now, paid-in capital in excess of par, what we can do here is just take the difference between the 52,000 and the 10,000, because our debits and credits have to equal. So we will credit paid-in capital in excess of par, 42,000. So now, Ortiz Corporation issued 2,000 shares of common stock. The stock had no par or stated value and was issued for a total of $52,000. So we'll start off with the accounts again for this entry. What are we getting as Ortiz Corporation? Well, once again, we are getting cash. Our cash is increasing, and so we need to debit our cash. And why are we getting cash? Because we issued common stock. So we'll credit common stock to make that account go up as well. So how much cash did we get? Well, we issued these shares for a total of $52,000. So once again, we'll debit our cash for $52,000, and then we have to credit common stock for a certain amount. Well, in this case, we didn't have a par or stated value, so we can't multiply the number of shares by the par value. Instead, we just need to go back to that rule of debits and credits have to equal. So since our debit is 52,000, our credit will also be 52,000. So the last one here, Ortiz Corporation issued 2,000 shares of common stock. The stock had a par value of $5 per share and was issued for land worth $52,000. So in this case, we aren't getting cash anymore. Instead of getting money for this stock, we are now getting some land. So we need to show that we're getting land by increasing our land account with a debit. So why are we getting this land? Why are people giving us plots of land? It's for this common stock that we are issuing, right? So we'll credit our common stock again. And then we also will be crediting paid-in capital in excess of par. So this one looks pretty similar right now to that first journal entry that we did. The only difference is instead of getting cash, we're getting land here. So let's figure out the numbers. Land, how much land are we getting? Well, we're told up in the problem that the land that we're getting is worth $52,000. So we'll debit our land $52,000. Now, common stock, we have a par value again. So now we can use that par value again to figure out our common stock amount. So we need to take the number of shares and multiply that by our par value. So we issued 2,000 shares, the $5 par value. So if you multiply those two together, you end up with 10,000. So we will be crediting our common stock for 10,000. For paid-in capital in excess of par, we need our debits and credits to equal. So right now we have 52,000 over on the debit side, 10,000 over on the credit side. So we need to credit 42,000 for our paid-in capital in excess of par. Now our debits and credits equal. Let's take a look at question number 2. So question number 2 says Rinehart Corporation purchased from its stockholders 5,000 shares of its own previously issued stock for $255,000. It later resold 2,000 shares for $54 per share, then 2,000 more shares for $49 per share, and finally sold 1,000 shares for $43 per share. So we need to prepare the journal entries for the purchase of this treasury stock and the 3 sales of treasury stock. So remember, whenever we buy back shares from stockholders, we always call that treasury stock. So if we want to journalize the purchase of this treasury stock from our shareholders, we have a couple accounts in this journal entry. So first we need to think about, what are we purchasing? We're purchasing this stock, right? And we're going to call it treasury stock. So we will debit treasury stock. And now how are we paying for this treasury stock? How are we acquiring it? Well, we're going to use cash. Since it says that we just purchased from our stockholders these shares for $255,000. So that tells us we're just using cash in this transaction. So now for our numbers. Well, we are going to value our treasury stock at the amount that we bought it back for. So we bought back this treasury stock for a total of $255,000. So we will debit treasury stock $255,000 and credit cash $255,000. Now we need to journalize the first time that we are selling back these shares, right? So the information at the top reiterates that we initially purchased 5,000 shares for $255,000. And then it says it later resold 2,000 shares for $54 per share. So now we're selling stock. So if we're going to sell stock, what are we going to get back? We're going to get back cash. Now, we are getting cash because we are selling treasury stock. So we need to increase our cash with this debit, but also decrease treasury stock with a credit. So we're decreasing our treasury stock because we're selling it now. So we don't have as much treasury stock left after this sale that we made. So to figure out our cash amount, we take our 2,000 shares that we sold and multiply it by the $54 per share that we sold it for. So 2,000 times 54 gets us 108,000. So we'll use that 108,000 as our debit to cash. For treasury stock, it's one extra step that we need to do. We are going to be valuing our treasury stock at the amount that we bought it back for originally. So we need to figure out the per share amount from when we initially bought back those 5,000 shares. So we're going to take the full $255,000 that we paid and divide it by the 5,000 shares that we purchased. And we'll see that we spent $51 per share for this treasury stock. So that $51 per share is going to be used to figure out our treasury stock amounts in all of these journal entries. So $51 per share, and we're selling 2,000 shares right now. So we'll multiply 51 by 2,000, and we get 102,000. So our treasury stock will credit 102,000. That's the value of this stock that we're selling. So you'll notice right now our debits and credits don't equal. We have one other account that's going to help us out here. It's going to be our paid in capital from treasury stock. So we'll credit that as well. And we credit that for the difference. So 108,000 minus 102,000 gives us 6,000. So we'll credit paid in capital from treasury stock for $6,000. Now, when working through a treasury stock problem, we want to keep track of this paid in capital from treasury stock balance. And you'll see why later on in this problem. So we will put that 6,000 over on the credit side in this T account for paid in capital from treasury stock. So now the problem tells us once again about what we purchased all these shares for, and then says it later resold 2,000 more shares for $49 per share. So we are selling them for less than what we initially bought them back for. So let's talk about the accounts here in this entry. We're still getting cash. We're still getting $49 per share. So we need our cash to be a debit in this entry to show that it's increasing. We're also still selling treasury stock. So we need to credit our treasury stock to make that account balance decrease. So if we figure out the amount for cash, we'll take our 2,000 shares that we're selling and multiply it by our $49 per share amount. So 2,000 times 49 gets us 98,000. So Rinehart Corporation is getting $98,000 in cash right now. So we will debit cash for $98,000. Now, our treasury stock amount. Well, we said it was $51 per share, right? And that $51 continues on throughout this problem. So we initially paid $51 per share. Here we're selling 2,000 shares. So 51 times 2,000 gets us 102,000 for treasury stock. So we will credit treasury stock for 102,000. So you'll notice a bit of a difference in this part of the problem compared to the last entry. Here we need to add more to the debit side to make our debits and credits equal. We are still going to use paid-in capital from treasury stock. So we'll debit paid-in capital from treasury stock. And then to figure out the amount here, we'll take the difference between our debits and our credits. So we need to debit our paid-in capital 4,000. Then once we write that in our journal entry, we can then show that $4,000 debit in our T account. So the balance in our paid-in capital from treasury stock is 2,000 on the credit side. So that'll come into play here in this next part. So now we are selling 1,000 shares for $43 per share. So Rinehart Corporation, we are still getting cash. Our cash is still going to increase in this problem, so we will debit cash. And why are we getting cash? Because we're selling treasury stock. So we'll debit cash and credit treasury stock. Now let's figure out the numbers for those two. So for cash, we're going to take the 1,000 shares that we're selling and multiply it by the $43 per share price that we're selling them for. So 1,000 times 43 gets you 43,000. So we'll debit our cash for 43,000. Treasury stock, it's still that $51 per share that we calculated earlier. This time, we'll multiply it by the 1,000 shares that we're selling. So 51,000 times 1,000 gets you 51,000. So we'll credit our treasury stock for 51,000. So, based off of the previous problems, we could be saying right now Well, let's just debit paid-in capital for the difference. But we can't do that because we don't have enough in our paid-in capital from Treasury Stock account. So that's why we have this T account over in the lower right-hand corner. That tells us that we only have $2,000 worth in that account. And your paid-in capital from Treasury Stock account can only have a credit balance or a zero balance. So the first step that you're going to take here is to debit paid-in capital from Treasury Stock for the full amount that you can. So we can debit that account $2,000, and that at least eats up some of this difference between our debits and credits. So we'll debit our paid-in capital from Treasury Stock $2,000 and put it down into our T account to now show we don't have anything left in that account. So now there's still a $6,000 difference. We still need to add $6,000 over on the debit side. Well, what you are doing in this transaction is selling your Treasury stock for less than what you bought it back for, right? So when that happens, you have to take from your paid-in capital, which we did with that $2,000, but then you're also taking away from your retained earnings. So your retained earnings will be debited for that $6,000. So you first figure out your cash and your Treasury stock amounts. Then you debit paid-in capital as much as you can. And if there's anything left over, that gets taken out of your retained earnings. All right, let's look at question number 3. On January 1st, Frontier Corporation had $1 million of common stock outstanding that was issued at par. It also had retained earnings of $750,000. The company issued 40,000 shares of common stock at par on July 1st and earned a net income of $400,000. So we need to journalize the declaration of a 15% stock dividend on December 10th if par value is $10 and the market price is $18. And then we need to journalize the issuance of that dividend on December 31st. So before we can even talk about journal entries, we need to figure out how many shares we have come December. So a few important pieces here to pull out of this problem right now is your common stock value, which was $1 million, and then your par value, which it told us under part A on the last slide was 10. So using those two numbers, we can figure out how many shares did Frontier Corporation have outstanding on January 1st. We can do that by taking our common stock value and dividing it by our par value. So if we take 1 million divided by 10, that will tell us that there were 100,000 shares outstanding on January 1st. So that's the first step that we need to do in this problem. Then it tells us that we issued more shares at par on July 1st. So we had 100,000, we issued another 40,000, so we add those two together, and we can see that we now have 140,000 shares. So July 1st was the last time during this year that our number of shares were affected. So going into December, when the stock dividend is being declared, we still had that 140,000 shares. So now we can start talking about journalizing the stock dividend. But before we even get to the journal entry, we now need to calculate how many shares are in this dividend. Well, the way we're going to do that is take the 140,000 shares outstanding that we had, and we're going to multiply that by our 15%. Because a 15% stock dividend means that you're handing out 15% more shares. So we're handing out 21,000 shares in this dividend. So we will use that 21,000 to calculate the numbers in our journal entry. So now we can finally talk about the accounts in our entry. So we are declaring a stock dividend. So you'll debit stock dividends. If we were declaring a cash dividend, we would debit cash dividends. So your declaration journal entry always starts off with a debit of whatever you are declaring. In this case, we are declaring stock dividends. So that's going to be our one debit in this entry. Then we have a couple credits as well. We'll be crediting common stock dividends distributable. That's an account that's sort of like a placeholder of, hey, we will be paying you these dividends later. So we will credit that dividends distributable account. And then we also credit paid in capital in excess of par. So now let's talk about the values for this entry. So for stock dividends, we're going to take our 21,000, the number of shares that we're handing out in this dividend, and we multiply that 21,000 by 18. And if you look up in part A of this problem, it says the market price is $18. So what you're doing here is you're taking your number of shares in the dividend and multiplying it by your market price. So if we do 21,000 times 18, we will get 378,000. So we'll debit stock dividends 378,000. Now to figure out common stock dividends distributable. Well, we are going to take our 21,000 shares, but this time multiply it by 10. And that 10 is your par value. So you're taking your number of shares in the dividend and multiplying it by your par value. So 21,000 times 10 gets you 210,000. So we will credit common stock dividends distributable 210,000. Now, this last piece, paid in capital in excess of par. So, there's a few different ways that we can calculate this. First, and probably the one that a lot of you have done in homework, is just make debits and credits equal, right? You would take your 378 minus your 210 and credit whatever that number is. But there's an actual way to calculate this number. So your paid in capital in excess of par is going to be your number of shares, right? Our 21,000 again. And then you're multiplying it by the difference between the market price and the par value. You're trying to figure out how far in excess of par, over par, are you at this market price. So we are declaring this dividend $8 above par. So what we're doing here is 21,000 times 8, and that will get you 168,000. So we will credit our paid-in capital in excess of par, 168,000. As you can see, 378,000 minus 210,000 gets you that 168. Now, we need to journalize the issuance of the dividend on December 31st. So we are going to start this one off by debiting common stock dividends distributable, because we are now distributing these stock dividends. So we will decrease our distributable account. And what are we distributing? Stock. We are handing out stock. So you'll credit your common stock account. But how do we figure out the numbers for this one? So we take a look back at our declaration journal entry, and we see that we put 210,000 in our common stock dividends distributable. So that's the amount that we have to take out of our distributable account. So we will debit common stock dividends distributable for 210,000, and we will credit common stock 210,000. So just like I said earlier, where the first account in your declaration journal entry is whatever you are declaring. So in our case, it was stock dividends. Well, the last account in your issuance journal entry is whatever you are handing out to your shareholders. In our case, that's common stock. Now, question 4. Robles Corporation was organized on January 1st, 2016. During its first year, the corporation issued 2,000 shares of $50 par value preferred stock and 100,000 shares of $10 par value common stock. At December 31st, the company declared the following cash dividends. So in 2016, there was $5,000. In 2017, there was $12,000. And in 2018, there was $28,000 of cash dividends. So what we need to do is show the allocation of dividends to each class of stock, assuming the preferred stock dividend is 7% and cumulative. Cumulative meaning that if they don't pay a certain amount, if they still owe their shareholders money from a previous year, they will have to pay them later on. So before we can allocate our dividends, we first need to figure out how much we're supposed to pay out to our preferred shareholders. So there's an equation that we can use. So our annual preferred dividend will be the number of preferred shares times the par value for preferred stock times your dividend percentage. So we had 2,000 shares times the $50 par value times 7%, which is 0.07. And if we multiply those three amounts, we will see that we are supposed to give our preferred shareholders $7,000 every single year. So we'll use that $7,000 now as we start to allocate these dividends. So 2016 happens, and we declare $5,000 in dividends at the end of the year. Well, that's a bit of a problem, right? Because our preferred shareholders are supposed to get 7, and we told everyone that we were only going to pay out 5. So what we do here is the preferred shareholders get their money first. So they are going to get all $5,000, leaving nothing for common. So you can think of it as the first $7,000 every single year need to go to preferred. Since we didn't break that $7,000 threshold here in 2016, there wasn't anything left over to give to the common shareholders. Now, the other piece to this, since this is a cumulative problem, we still owe $2,000 to preferred shareholders. Those are called dividends in arrears. So we will have to pay that $2,000 down the road. So we take a look at the next year, in 2017. In 2017, we had a better year, so we declared $12,000 in dividends. Well, $12,000 is going to not only handle the $7,000 that preferred is supposed to get every year, but can also help us pay back that $2,000 that we owed them from the previous year. So preferred will get $9,000 here in 2017. They get the $7,000 that they're supposed to get every year, plus that $2,000 that they didn't get in the previous year. So now to figure out what common gets. Well, there was a total of $12,000 of dividends being paid out. $9,000 went to preferred, so the rest will go to common. So if we do $12,000 minus $9,000, we get our $3,000 amount. 2018, we had a spectacular year, and we declared $28,000 in dividends. Well, so we first need to figure out what preferred gets. We don't owe preferred anything from previous years anymore, right? We paid off that $2,000. So we've paid them everything that they're supposed to get up to this year. Now, in this year, they're just supposed to get $7,000 because that's their annual dividend that we calculated. So they just get that $7,000. And now we take a look at our common shareholders, and they get whatever is left over. Right? So we had $21,000 left over after we paid our common, after we paid our preferred. So that $21,000 goes to our common shareholders.